There's over $150 billion sitting in digital coins designed to never move in price. Sounds boring, right? Wrong. Stablecoins are the silent backbone of the entire cryptocurrency economy. They're how traders escape volatility, how DeFi applications function, and increasingly, how people in unstable economies protect their savings. But here's the thing. Not all stablecoins are created equal. Some are backed by cold, hard cash and bank vaults. Others are backed by, other cryptocurrencies. And some, they're held together by algorithms and hope. Today, we're breaking down every major stablecoin you need to know, how they work, what backs them, and most importantly, which ones you can actually trust. First up, the grandfather of stablecoins, Tether, or USDT. Launched in 2014, Tether was the first stablecoin to gain mainstream adoption. And today, it remains the largest by a massive margin, with a market cap exceeding $110 billion. Here's how it works. Tether Limited claims to hold $1 in reserves for every USDT token in circulation. You give them dollars, they mint USDT. You return USDT, they burn it and give your dollars back. Simple, right? Well, kind of. Tether has faced persistent controversy over its reserve transparency. For years, they refused full audits, and when they finally revealed their backing in 2021, it included commercial paper and other less liquid assets, not just cash. Despite the drama, USDT dominates trading pairs on virtually every exchange. It's the default stablecoin for traders, especially in Asian markets. Love it or question it, you can't ignore it. Now, let's talk about Tether's biggest competitor, USD Coin, or USDC. Launched in 2018 by Circle and Coinbase through the Center Consortium, USDC positioned itself as the transparent alternative to Tether. Unlike Tether's murky attestations, USDC publishes monthly reserve reports verified by major accounting firms. Their backing? Primarily cash and short-term US Treasury bonds, the gold standard of safe assets. USDC became the darling of institutional investors and DeFi protocols precisely because of this transparency. At its peak, it held over $55 billion in circulation. However, USDC faced its own crisis in March 2023 when Silicon Valley Bank collapsed, temporarily holding $3.3 billion of Circle's reserves. USDC briefly depegged to 87 cents before recovering. The lesson? Even the most transparent stablecoin carries risk when banks fail. Today, USDC remains the second largest stablecoin and the preferred choice for regulated applications. Here's where things get interesting. DAI isn't backed by dollars in a bank at all. Created by MakerDAO. In 2017, DAI is a decentralized stablecoin backed by cryptocurrency collateral locked in smart contracts on Ethereum. Think of it like a pawn shop. You deposit Ethereum or other approved crypto into a vault. The system lets you borrow DAI against that collateral, but you must over-collateralize. Deposit $150 worth of ETH, borrow only 100 DAI. If your collateral's value drops too low, the smart contract automatically liquidates your position to protect the system. This makes DAI censorship resistant. No company can freeze your DAI. No government can seize the reserves. It's truly peer-to-peer money. The trade-off? DAI is more complex, occasionally wobbles from its peg during extreme volatility, and carries smart contract risk. But for crypto purists who want decentralization, DAI remains the undisputed champion with over $5 billion in circulation. BUSD was once the third largest stablecoin until regulators killed it. Launched in 2019 through a partnership between Binance and Paxos Trust Company, BUSD was actually issued by Paxos and regulated by the New York Department of Financial Services. That's important. It meant real regulatory oversight. BUSD offered zero fees for trading pairs on Binance, making it incredibly popular within that ecosystem. At its peak, it held nearly $23 billion. Then came February 2023. The SEC sent Paxos a Wells notice, essentially a warning of impending lawsuit, claiming BUSD was an unregistered security. Paxos immediately stopped minting new BUSD. Today, BUSD is being phased out. Binance has transitioned to other stablecoins, and existing BUSD holders can redeem through Paxos until 2025. BUSD's death serves as a stark reminder. Regulatory risk is real, even for compliant stablecoins. True USD, or TUSD, was actually launched before USDC back in 2018 with a unique selling point: real-time reserve attestations. Instead of monthly reports, TUSD partnered with Chainlink to provide live on-chain proof of reserves. At any moment, you can verify that dollars in bank accounts match tokens in circulation. TUSD gained significant traction in 2023 when Binance briefly promoted it as a BUSD replacement, offering zero-fee trading pairs. However, questions emerged about TUSD's actual reserve management and the entities controlling those funds. The company structure is complex, involving entities in the British Virgin Islands and partnerships with various custodians. With a market cap hovering around $500 million, TUSD remains a mid-tier player. It's an interesting case study in how technical transparency, live attestations, doesn't automatically mean full transparency about who controls the money. Now for something completely different. Frax, the hybrid stablecoin. Launched in December 2020, Frax pioneered the fractional algorithmic model. Part of each Frax token is backed by collateral, primarily USDC, while the remaining portion is stabilized algorithmically using Frax's governance token, FXS. Here's the clever part. The ratio adjusts based on market demand. When confidence is high, the algorithmic portion increases. When people get nervous, more collateral backs each token. Think of it like a trust dial. The system reads market conditions and calibrates backing accordingly. After the catastrophic collapse of Terra's UST in 2022, which we'll mention shortly, Frax actually moved toward full collateralization. They essentially said, you know what, let's just back this thing properly. Frax is smaller, around 650 million in circulation, but it's a fascinating experiment in programmable monetary policy. PayPal USD, or PYUSD, represents something huge, mainstream fintech entering the stablecoin arena. Launched in August 2023, PYUSD is issued by Paxos. Yes, the same company behind the now-defunct BUSD, and is fully regulated by the New York Department of Financial Services. Here's why it matters. PayPal has over 430 million active users worldwide. That's massive distribution power no crypto-native stablecoin can match. PYUSD is backed by US dollar deposits, short-term treasuries, and similar cash equivalents. Monthly reserve reports provide transparency. Initially launched on Ethereum, PayPal expanded PYUSD to Solana in 2024 for faster, cheaper transactions. Critics argue PayPal's centralized control defeats cryptocurrency's purpose, but supporters see PYUSD as a bridge, bringing stablecoin technology to regular people who've never touched MetaMask. With PayPal's brand recognition, PYUSD could eventually challenge USDC for mainstream adoption. We can't discuss stablecoins without mentioning Terra USD, or UST, the $40 billion disaster. UST was purely algorithmic, maintaining its peg through a complex relationship with Terra's Luna token. No real dollars backing it, just code and incentives. In May 2022, a coordinated attack triggered a death spiral. UST lost its peg, Luna hyperinflated into oblivion, and investors lost everything within days. This wasn't a small failure. It wiped out life savings, bankrupted companies, and triggered industry-wide contagion. The UST collapse proved that purely algorithmic stablecoins, at least current designs, cannot survive extreme market stress. Every serious stablecoin today maintains substantial real-world collateral. Remember, if someone promises you stable value backed only by an algorithm, run. So there you have it, the complete stablecoin landscape. From Tether's controversial dominance to USDC's transparency, from DAI's decentralization to PayPal's mainstream ambitions, each stablecoin makes different trade-offs between trust, regulation, and decentralization. Here's my question for you. Which matters most? Decentralization like DAI or regulatory backing like USDC? Drop your answer in the comments. If this breakdown helped you understand stablecoins better, smash that like button and subscribe for more crypto explainers. We break down complex topics, so you don't have to. Thanks for watching. See you in the next one.